Hi, it's Lee, and welcome to the Tesla Economist. I'm sure you all heard Elon recently on Twitter Spaces. The good news was that he said he would no longer be selling any more Tesla shares for 18 to 24 months. But it looks like the damage is already done. Elon also still thinks that Tesla could become the most valuable company in the world, except this time, he added a time for when this might occur, saying within 5 years. So there you go. Elon thinks you might be able to get 10 times return from today's low stock price. Or at least they sure feel low now, with a trailing 12-month PE ratio of 38. However, the future PE, well, that was starting to look crazy. Or at least until Elon said that Tesla may even reduce their prices to break even or a slight loss. This would be if we are in a scenario of still really high interest rates and quite a serious recession that Elon compares to 2009. So Elon says that because we would be in a recession, we would have reduced demand, which is what happens in the auto industry as it's cyclical. Then, with higher rates, cars are effectively more expensive to buy. Elon says that in that scenario, you have to decide on what level you want to grow unit volume. Do you lower production, maintain growth, or do you increase production? Then that would all come down to what prices you wish to sell your products. Elon says his preference would be to grow as fast as they can without putting the company at risk. Elon is saying the reason for this is that the cars possess something that the others do not, in that their cars can be upgradable to full autonomy. So I think Elon believes that this is his objective still, to get as many Teslas out as possible so there are autonomous vehicles out there when FSD is ready. The question is though, how low a price are we talking here? We know Tesla were making good profit margins when the Model 3 was only $37,000, and the waiting list in the US was just 3 to 6 weeks then. We had $49,900 for the Model Y long range, with 2 to 6 weeks delivery. These were the prices back in early 2021, when the stock was still around $285. In the Tesla financials, we still saw the autos without regulatory credits getting 22% margins at that time. And this was also during a Model Y still ramping in Shanghai. In Q3 2020, they had reached 23.6% margins. This is why we felt so comfortable staying invested with the company. These were low-cost EVs and still highly profitable, along with a lot more potential to reduce costs further. Tesla became far more popular in the last 2 years, along with EVs in general. EVs are a better way of driving and of course cost significantly less to run. They come with massive cost savings, perhaps $1,500 a year in the US, but twice that in some nations, which does add up. An EV is a deflationary good. Teslas just appear expensive as they've had to deal with huge waiting lists and have increased prices as a result. And people refer to Tesla as a high-end luxury car because it is. It's a comfortable drive that handles well, has the best safety, and very highly optioned. However, Tesla are so good at manufacturing, they've managed to get the cost of a luxury vehicle built for the price of a regular vehicle, along with vertical integration and economies of scale. Basically, Tesla are producing a lot of car for the same cost that ICE produced something reasonably basic. For all the reasons we've discussed before at how Tesla save costs. And then this end product being one that also has a lower running cost as it doesn't need fuel. So costs have likely risen with inflation since the start of last year, although Elon says he is now seeing deflation and of course more vertical integration and improved manufacturing processes. But even if we said that Tesla would break even if they sold a Model 3 for $35,000, then with a tax credit it takes it down to $27,500. A Toyota Camry starts at $26,000 and you have to pay for gas. And they're very standard, especially compared to a Tesla. This is the US, of course, that does have this tax credit, but equally, cars also cost less than the US. My point is that it would be very unlikely that Tesla would need to drop their prices to a break-even price, and we are saying that it cost Tesla about $28,000 to $29,000 perhaps to make a Model 3 back in 2021 if we're going by those margins, implying that it should cost less than $35,000 to make a Model 3 in the US today. The same for the Model Y. If we're talking about $50,000 at perhaps 22% margin, that would be a $39,000 cost. And even if it's $42,500 now, with the tax credit, it would take it down to $35,000. A BMW X3, which is not even close to the same level of car, starts at $45,000. This is the US, which is the market that has experienced the highest price rises and thus the most margin buffer to start with, and then the tax credit. Basically, I would assume that Tesla do not need to sell their cars at break even, let alone a small loss. If this has occurred, then there may be worse things to be worried about. The economy would be dire. Legacy auto manufacturers would be bankrupt. They would have bailouts, but we would assume that if we are in that situation, the reserve banks have pivoted by then. And other markets do also offer subsidies, so it will be a similar scenario there. But if Tesla reduced their prices to break even in markets like Australia or New Zealand, they would cost less than the BYD equivalent. I am talking no gross profit for Tesla, and in all fairness, BYD do make some gross profit on their vehicle sales, so it's not an entirely fair comparison, but I'm just trying to use these price drops for indicative purposes. I don't think Tesla will need to operate at break even. I think they can maintain a profit through the recession. Remember, the recession is controlled. It's up to the reserve banks how hard they want to make it. I think they just want everyone to get the message and stop spending, slow down money, and wait for everything else to catch up. If they go too far, then even cutting rates and quantitative easing won't necessarily be enough to restart the economy again. Elon's basically saying that even in a worst case scenario, Tesla is prepared to grow production still, so much so that they are even prepared to do it even if it meant they sell at break even or perhaps a slight loss. But when we see these numbers of how low the prices would become, and we factor in how the demand is so much more elastic for EVs in general, and Teslas too, if Tesla had to lower their prices to break even, then it would mean the aggregate demand is so low that Tesla would end up with about 30% market share in the US or something. So this ends up being a double whammy for legacy autos. There'd be less demand in the first place for people who want to buy cars. Then if Tesla's prices are considerably lower, their prices are relatively lower to the competition, which means the competition are losing aggregate demand and then losing demand from customers buying a Tesla instead. However hard it is for Tesla, it's just going to be so much harder for everyone else. The market is panicking and some Tesla investors are even more. It's a very unpleasant feeling, losing so much money. This is tough to get through. But at the same time, as far as we can tell, it looks like Tesla has the best chance of coming out the other side in the best condition. The point is, Tesla is in a good position to weather this storm, and they have a strong cash position on top of that. Elon has been through these situations in the past, and he is preparing for the worst, as it was incredibly stressful for him last time. This also includes the reason he was having to sell for Twitter. This isn't going to change until the Fed pivots, and even when they do, we don't know what state the economy will be in at that stage. If it is this bad, then we would have seen massive deflation, which would have also meant that Tesla's costs should have come down too. On top of that though, we do have Tesla's sleeping giant that is starting to wake up finally. All that rhetoric Tesla bulls have been saying over the years, that Tesla isn't just a car company, well hopefully this is the time when we finally do see that. There's some serious rumours going around already about energy, one being that the run rate is already at 35 gigawatt hours a year. And I did some numbers and managed to see potentially 50% margins. And that didn't even include the subsidies. Others in the community are even suggesting margins could be as high as 60%. Unlike cars, energy is not cyclical. People need energy all year round in all economic environments. This would be a great hedge to Tesla that we've been waiting for so long. Potentially an additional $8 to $10 billion in operating profit next year. I'll put together an estimate of 2023 with price cuts and see what it comes to. Happy Christmas, everyone. Thanks for listening. Please hit the thumbs up and remember to subscribe, and you can talk to me on Patreon.